Okay, so we appreciate everybody coming out. This class doesn't necessarily apply to the masses. It's a little bit different than what we normally do. This class is specifically for those that are looking to hedge price risk in the grain markets or the meat markets. We're probably going to, and actually not probably, we are going to talk more about grains than meat, but these principles can be applied to just about any commodity that you're trying to hedge. So if you're not familiar with us and what we do, we are DeCarly Trading. We're located in Las Vegas, Nevada. My name is Carly Garner. Here's my contact information. If you have any questions or comments or concerns, you can certainly email me, you can give me a call, or you can check us out on Twitter and Facebook or Instagram. We try to post some charts and market commentary and that sort of thing, but we also post pictures of dogs and fun things. So hopefully we see you there. I am a broker, a strategist, and an author. I write a column for Stocks and Commodities magazine. It's titled Futures for You. I also contribute content to Jim Cramer's Mad Money. On Jim Cramer's Mad Money, we tend to focus on the energy markets, natural gas, crude oil. But I also do write a couple of newsletters for our brokerage clients. We're a brokerage firm. That's our bread and butter. So we provide our clients with trading recommendations, market guidance, commentary, that sort of thing. Obviously, we don't have a crystal ball, but we do the best we can. We've been doing this a long time, and more often than not, I think we have a pretty good handle on the markets, but in the end of the day, nobody knows what's going to happen tomorrow. Another benefit that we provide to our clients is a mobile app. This mobile app is not necessarily for trading. In fact, it's not for trading. It's for informational purposes. We communicate with our clients via push notifications with the mobile app, trading recommendations, that sort of thing. They also have access to news feeds, video feeds, all of that kind of stuff. And it's free to download. Even if you're not a client of ours, you can download it and you'll get all the news and the information, everything except for the trading recommendations. Those are exclusive to clients, but you'll get everything else. All right, so I've written 4 books. I've written a couple of these more than once. We've revised them to keep up with changes in the industry and technology and that sort of thing. If you're a beginning trader, A Trader's First Book on Commodities, in my opinion, is a great resource. If you're beyond the beginning steps of trading, I think Higher Probability Commodity Trading will be a great step for you. In my opinion, Higher Probability Commodity Trading is an extremely valuable tool, and that it's different than most of the books out there. I'm not saying it's necessarily better, it's just different. There's a different perspective. We offer a lot of ideas on trading options versus futures, and that's actually what we're going to focus on today, is the idea of when you do put together a hedge, it doesn't have to be 100%, and you can be creative with it. You don't have to just simply buy puts or sell futures. You can do something in between. There is a substantial risk of loss in trading futures and options. It is not suitable for everyone. And I say this even though we're talking about hedging today. So the idea of hedging is to reduce price risk, but that doesn't mean that there's not some sort of risks involved, and we'll talk about that. If we're reducing price risk, we're probably accepting some sort of opportunity cost. So the first thing we're going to talk about is why hedge. A lot of farmers and ranchers just simply don't hedge. They don't think they need to, or they don't want to, or whatever the case is. They think that the product that they're holding, that they've planted in the ground and they will eventually sell, will increase in value, and they just simply want to take their chances. But failure to hedge is basically the same thing as speculating. It's cash market speculation. So if you're not hedging, you are speculating. There might be a time where this is appropriate. So for example, if grain prices are extremely cheap, you might not want to put a hedge on. It's probably not the best time to put a hedge on. You want to put a hedge on when grains are expensive, because the idea of a price hedge is you want to reduce your risk of adverse price movements. Well, if the market's at a price that's relatively cheap and at a point that the market probably won't go a whole lot lower, then there's no sense in hedging at that point. So in my opinion, if you're a grain farmer with soybeans and corn kind of down towards the lower end of what we've seen in the last couple of years, if you're going to hedge from these current prices, if you didn't have a hedge on already, you probably missed the boat. And so you want to keep any hedging really small from here, or something that makes sense, not something that's very aggressive, because if the market does rebound, as we go into the late summer, early fall, which in my opinion, I think there's a decent chance of that, then you don't want your hedge to cause more harm than it did good. So the great thing about hedging is certainty. Most farmers focus on production and expense risk. I mean, the farming business is tough, and there's a lot of skill that goes into it. There's a lot of planning. So if you're planning and you're using budgets and you purchase, you're interested in crop insurance and all these sorts of things, you better make sure that you know the prices that you're working with. And hedging basically locks in a price so that you can budget throughout the year and figure out what your situation is before we get to October or later and some sort of surprise occurs that throws off your entire budget. A downturn in prices can be just as devastating as a poor yield or something catastrophic. So even if hedging might eliminate the upside potential or the open-ended profits that sometimes occur, I mean, we all remember wheat, and I think it was 2007. We all remember corn a handful of years ago getting into the $10 area. I mean, those sorts of things do happen, but unfortunately for farmers, they're rare. So you don't want to bank on something like that happening each and every year, and because it's not going to happen often. It might happen once or twice a decade. So a better bet is to hedge your price risk. Anytime there's a big upswing and corn gets a little pricey or wheat gets a little pricey relative to where it's been in recent months or years, that's when you put a little bit of a hedge on, and you may get more aggressive as the market moves higher. And as the market moves lower, you get less aggressive. You take your hedge off or you sell options against it, and we'll talk about that. So just like anything else in life, a bird in the hand is worth two in the bush. So in my opinion, a hedge doesn't have to be scientific. Most people are looking for black and white answers, and it doesn't have to be like that. In fact, I think it probably shouldn't be like that. I think you can get the best of both worlds. You can hedge some of your price risk and allow some upward momentum or upward potential in your exposure. It's understandable that producers don't want to miss out on a potentially lucrative rally in the underlying commodity. Again, we all know how crazy grains can get when they do start moving higher. So you don't want to be the guy that sold corn at $4 when corn goes to $7 or $8. Likewise, you don't want to be the guy that sells soybeans at $9.50 when beans go well into the teens. But at the same time, nobody knows what year we're going to see that explosive move. Nobody knows how high that explosive move is going to go. So the best bet is to simply play the odds, and that is, like I mentioned, incrementally hedging as the market goes up and incrementally taking that hedge off as it goes down. Of course, we're human, so as farmers and ranchers or some sort of end producer or user, we tend to see future pricing with rose-colored glasses. We always think corn's going to the moon. It's just how we are. Again, we want to play the reality, not necessarily what we want to happen. So let's talk about a basic hedge. A basic hedge is the practice of taking an offsetting position in a related asset or security to reduce the risk of an adverse price movement. So for example, if you've planted corn that you plan on harvesting later this fall, and you know at some point you're going to need to sell that corn, you could take, you're basically long corn in the cash market. So you could take an equal and opposite position in the futures market, which would be shorting corn. And the idea of that would be is corn prices go higher, your cash market inventory increases in value, but your futures contract loses money for you and vice versa. So you're basically locking in your price and you're eliminating price risk. That's the idea of a hedge. The futures markets, believe it or not, I know most people don't realize this or most people don't use it in this manner, but the futures markets were created for the purpose of hedging. The idea is producers and end users can hedge their price risk by shifting that to speculators. So just like, just as a farmer is trying to eliminate his risk, a speculator is trying to bet on market prices moving one way or the other. So they're both getting something out of the relationship. There really is no such thing as a perfect hedge. If it did occur, it would eliminate all price risk. The reason there's no such thing as a perfect hedge is markets are they're not perfectly efficient, unfortunately. Assets are rarely priced perfectly. There's transaction costs to consider, there's slippage, there's basis, and all of these things interfere with the theory of a perfect hedge. So let's assume that you exactly have expectations of a yield in increments of 5,000 bushels. Remember, futures contracts trade in 5,000 bushels. So obviously most farmers, when they plant corn, their goal isn't to necessarily have a end yield in increments of 5. So things are going to be a little bit sloppy. Also, there's a difference between the price of corn in the local market versus what it's doing on the futures exchange. And that's known as the basis, and the difference between those two prices will expand and contract, and so that interferes with the perfect hedge. But if there was a perfect hedge, the way to do it would be with a futures contract. You're locking in your price. Let's say, for example, you think you're going to be looking to sell your grain in December. So if you wanted to sell corn at, we'll just say 380, I guess we probably wish it was 380 at this point, but if you wanted to sell December corn at 380, and you were able to do so in the futures market, that would lock in your price at 380. So whether corn went to 320 or 420, by December, it wouldn't really matter in theory because your futures position has already locked in that price, and that's the price you have to work with. So if you wanted to get as close to a perfect hedge as you possibly could, you would basically sell one futures contract for every 5,000 bushels of corn or wheat or soybeans, whatever it was that you're hedging. In theory, these two positions would be perfectly negatively correlated. If you were expecting 10,000 bushels of corn, you would sell 2 futures contracts. If you were expecting 20,000 bushels of corn, you would sell 4 futures contracts. Again, obviously your yield's probably not going to always round out to being perfectly 5,000 bushels. There are many contracts that will allow you to pinpoint your hedge a little more precisely if that's necessary. I really don't think you want to ever give up the entire upside potential, or at least not unless grains are healthy in price. So maybe if corn was at $4 to $4.50 this time of year, then yeah, maybe it would make sense to have an almost perfect hedge on. With corn well under $4, it probably doesn't make a lot of sense. I think you should probably have some sort of price protection under the market, even when the market's cheap, because cheap markets can get cheaper, but you don't want to give up all your upside potential. Under most conditions, probably the best way to go about things is a partial hedge, not a perfect hedge. And it's ideal because it offers downside protection without forfeiting upside profit potential. So for example, and we're still talking about futures hedges, we will talk about option hedges later, but for example, if you are a farmer and you expect 35,000 bushels of corn to be harvested, you could sell 4 futures contracts to hedge 20,000 bushels. So that leaves 15,000 unhedged. You basically are locking in your price on 20,000 bushels. Most farmers that hedge, they tend to go all out. They hedge either all or nothing, and it really doesn't have to be like that. Sometimes it's hard to untrain ourselves. I really think that the best way to go about this is incrementally. So alternatively, another way to get a partial hedge on so that you have some sort of price protection, but you still are leaving yourself open to runaway gains if that's what's going to happen, is you could use options rather than futures. And I think options in most situations are the best way to go. You could buy puts, which is the same as buying insurance, and we're going to go over this in a little more detail soon. You could sell calls for basically to bring in income, or you could do a little bit of both. So let's take a look at an example here. Short futures hedges are probably the most popular form of hedging, and it's probably the simplest form of hedging. In essence, a short grain futures position is initiated to substitute for the eventual sale of the underlying commodity. We really just kind of spoke about this. It enables producers to lock in a price well before harvest, and in that way, they can budget for the entire year without necessarily knowing exactly what the price of corn is going to be in December. The price protection obviously lasts as long as the futures position is on. At any time, the farmer can offset his hedge. So again, the idea of a futures hedge is, as the cash market is going up, your futures hedge is losing money, but as the cash market goes down, your futures hedge is making money. So you've locked in your price. So as a farmer, it's inconsequential what the price of corn does between the time you hedge and the time that you actually sell your grain. Almost doesn't matter, aside from slippage and basis and those types of things that we've already discussed. So you can customize your futures hedge. Again, this doesn't have to be black and white math. It doesn't have to be science. It can be an art. You can use a combination of full-size grain futures, which are 5,000 bushels apiece, as well as mini grain futures to get into, like, let's say, for example, you're a farmer and you have, we'll just say 7,000 bushels of corn. You could sell 1 full-size contract and 2 minis, and that would lock in the entire 7,000 bushels. So if you see what I'm saying here, you can actually create a semi or a near perfect hedge by customizing it using both full-size futures and mini futures. The great thing about using mini futures is it will allow you to average your price in and out. And again, when prices are overbought, you want to be selling to lock in prices. When prices are oversold, you want to be offsetting any hedges that you have. And you certainly don't want to be putting hedges on when prices are oversold. So this is basically a chart of corn for the last year and a half or so. Anybody that's been trading corn knows exactly what happened here with the tariff tantrum. China and U.S. tariff talks really got out of hand, or at least the grain market interpreted it that way. So beans dropped from roughly 10.60 down to 8.70. We're talking a $2 plunge in a couple of weeks. That sort of thing rarely happens, but it does happen. And that's the perfect reason why farmers always want to have some sort of hedge on. You just never know politically what's going to change. It might be a weather change. It might, I mean, anything could happen. We have no way of seeing the future. So it's always a good idea to have some sort of price protection at all times. An indicator that I like to look at is the RSI. It's the Relative Strength Index. You should never trade or hedge solely based on this indicator. That's not what I'm saying. But what I'm saying is it's a very simple way to judge whether a market is oversold or overbought. The RSI rarely stays below 30, and it rarely stays above 70. So anytime you see an RSI getting above or below these markers, and again, this is super simplistic. It's not this simple, but I'm just trying to give you some ideas. This is when you want to start thinking about hedging. If you would have hedged with the RSI up in the 70 area, you would have put a hedge on somewhere in here. Obviously, that would have worked out pretty nicely. If you would have lessened your hedges when the RSI is down in this range, around 30, that would have worked out pretty well also, because then you can reload your hedge up here. So the idea is you never want to be completely naked, but you never want to have a full hedge on either unless you're on a big spike up. The only time to have big aggressive hedges on are up on these big spikes. In the grains, sometimes spikes take off and they never end, but that's rare. That might happen once every 4 years, 5 years, maybe even less than that. In most occasions, you see giant up moves in grains fizzle out. As a hedger, that's a very important piece of information. So just to give you an idea of how much money we're talking about and how much a hedge could save an entire crop year, a farmer that hedged somewhere around 10.50, and again, that wouldn't have been a perfect hedge. You'd see it did go a little higher, but you're never going to catch the top or the bottom. That's just how it is. But somebody that hedged in this general ballpark would have bettered themselves by $1.50 per bushel, or $7,500 per 5,000 bushels. So obviously they can make a really dramatic difference in the bottom line at the end of the year. Now, to be quite honest, I would say if you were using our approach to incrementally hedge as the market goes up and then incrementally take off hedges as the markets go down, you'd see there's like a nice trend line here that eventually broke. This type of a move is rare, but it does happen, and I would venture to say that if I was working with someone and we were hedging crops, we probably would have taken off the hedge too early. We probably wouldn't have benefited from the entire move. But the reality is if you benefit from a good chunk of it, that's better than nothing. So I mean, just to reiterate that, we're talking, in the previous slide, we were talking about $7,500 per 5,000 bushels. Imagine a farm that is doing 35,000 bushels, 40,000 bushels. I mean, the money can really, really add up, and it can mean the difference between having a great year and being in the red at the end of the year. So the advantages of a short futures hedge, and again, remember this is futures, not options, is that it eliminates the risk of a price decline if you're implementing a full hedge. It basically establishes a sales price in advance, and it offers better budgeting. Also, futures transactions are guaranteed by the exchange. Options are as well, but this is a benefit that I just wanted to point out. Don't fear that if you put on a hedge that there's going to be something that interferes with you being able to get your money out, because the exchange guarantees every trade. Now, there are some disclosures, brokerage firm failures and things like that, which I'm not going to say can never happen, but it would be very rare. So generally speaking, you shouldn't have to worry about anything other than market price. And futures hedges are very, very simple. They're easy to understand. They're easy to put on. That's why people tend to use them. But the disadvantages are it eliminates profit potential of higher prices. So if you establish a full futures hedge and the market goes higher, you've foregone any benefits of upside prices. So in my opinion, I ask, why not try to have the best of both worlds using options? So somebody's asking, why not just buy beans now since the price is relatively low? And I actually agree with you. I think that buying call options in soybeans, or we have a bullish position on in soy meal where we're long the futures and then short a call above the market and long a put below the market. So I agree that from a speculative standpoint, it's probably not a bad time to be buying soybeans. From a hedging standpoint, the best thing to probably do is just sit on your hands. So if you do not have a hedge on at this particular time, probably just sit tight, maybe buy some catastrophic insurance via cheap puts. But other than that, I don't think it makes sense to take any action from a hedging perspective. From a speculating perspective, absolutely, I would play the upside. So when you're playing with options rather than futures, you have plenty of options, pardon the pun. So just to give you a basic idea of what options are and what they do, option buyers are paying a premium for the right to buy or sell a futures contract at a specific price. So if we're talking about corn, if you buy a $3.50 corn put, you are buying the right to be able to sell corn at $3.50. So if you're a farmer and you buy a $3.50 December put, you would be basically locking in at least $3.50 per bushel on your crop or more. If the market's above $3.50, obviously you wouldn't, that option is going to expire worthless. It's not going to do anything for you, but it did give you peace of mind over the last 5 or 6 months. The problem with buying options is that they're eroding assets, just like when you buy a car and you drive it off the lot, it erodes. Same thing happens to options. So if you buy a put option to protect your downside risk and nothing happens, that put just slowly erodes to nothing. So you're not getting any benefit, and it can be really expensive if you continually buy puts to hedge your price risk. The nice thing about buying puts for insurance against your crop is they're extremely liquid, so it's a heck of a lot better of a choice. This is my opinion. I believe it's a better choice than trying to buy crop insurance or some sort of price insurance through an insurance company, because in the futures market, you can buy your insurance and you can sell it if you feel like you don't need it, or if it goes in your favor and you can cash out at a profit, you can always take the money off the table. You wouldn't be able to do that with a regular insurance policy. So an option seller is doing the option seller is basically the insurance company. They are receiving money or receiving premium for the responsibility of delivering the futures contract to the buyer. So if a hedger buys a corn put with a $3.50 strike price, he's guaranteeing that he can sell corn at $3.50 if he wants to. If corn's at $3.80 or $3.90, obviously he doesn't want to sell it at $3.50. The option expires worthless and it's gone. The seller of that option is the person that benefits if the option expires worthless. So if that event does not happen, the seller gets to keep the premium. So in their simplest form, options are basically insurance. Premiums are paid by those wishing to have insurance to those willing to accept the consequences of a specific event occurring in exchange for additional income. Specifically, look at what strategies farmers or ranchers can do to protect their price risk. They can buy put, which is essentially the exact same thing as buying insurance against a price decline to a specific price. It's not free and it's not cheap, but it does come in handy if there's a large price decline. And cost management is extremely critical. So buying puts is simple and it provides a floor under pricing, but if you're buying puts each and every year to protect your crop, it's going to be extremely expensive. And the nice thing is it does give your cash market holding the ability to increase in value if market prices go higher. Still going to be an expensive ordeal. I know, I mean, I haven't, the prices actually in the grain markets fluctuate dramatically, but you're talking about per 5,000 bushels. I mean, in soybeans, it could easily be several thousand a year just hedging your price risk. Another idea to keep in mind is farmers and ranchers can sell puts to generate income against their short futures hedges. So I'm not saying that you should, if you're holding corn in the ground or soybeans in the ground, I'm not saying you should sell puts to bring in income. That's not what I'm saying. What I'm saying is if you establish a futures hedge, if you go short the futures and it goes in your favor, let's say that you sell soybeans at $10.50 and the market drops to $9.50 or $9, you could do two things. You could cash out. You could just offset your profit and leave the rest to speculation, because remember, if you take your futures hedge off, you're basically cash market speculating. If the value of your crop goes down, you have nothing there to hedge yourself. But you could do the best of both worlds by selling puts against it. So if you are short a futures contract and the market's declining, but you think that the market might find support or maybe most of the selling's over, what you could do is sell a put underneath the market. And all that does is it brings in some income, and it does cap your profit potential on the downside. So if soybeans go lower than the strike price of the option you're selling, you're not going to benefit from it. It can be a great way to take advantage of price swings and just put yourself in a situation where not only are you hedging, but you're also possibly generating a little bit of income. So a farmer that doesn't really want to spend money to buy puts and doesn't want to have a perfect hedge, but is interested in generating a little extra income to cushion his downside price risk. So this would be in a scenario if you think value of corn could go a little higher, but it probably won't go much lower. Like if you're expecting a low volatility year, you could possibly sell calls against your cash market holdings. All this does is it limits the upside profit potential, but it'll generate income as you're going. And so in some particular situations, that might be attractive also. To be honest, that strategy alone, if you're just selling calls against the crop that you have in the ground, it's highly speculative, but it is better than having no hedge at all, for sure. So let's take a look at long option hedging. When you buy a put option, you're basically establishing a minimum selling price or a floor while still retaining upside price potential. We're going to take a look at some examples and some charts so you get a better idea of what we're talking about here. But the idea is it's essentially purchasing insurance against a dramatic price decrease. So again, we've mentioned this before, but I want to make sure you understand insurance isn't free and it's not cheap, just like we can't buy cheap and free car insurance. We can't buy insurance for our crops either. It's extremely important that you keep your costs low when you're executing this type of a hedge. Puts can be really, really expensive. So you want to buy it when you can, not when you need to. If you wait for the bottom to fall out in the market, you're going to pay way too much for your insurance and you're going to get very little out of it. So for example, again, if you have had no crop insurance whatsoever or no hedge on whatsoever in soybeans over the last couple of months, you're probably regretting that. But now is not the time to be buying put options. They're way overpriced, and so you're going to get very little bang for your buck trying to do it at this particular time. Another thing to keep in mind is not only are put options expensive, but they only benefit the farmer or the rancher if somebody actually offsets them. So if you buy a corn put and the corn market collapses and that put increases in value, that's great because it's hedging your cash market holdings. Everything's going as planned. But the problem is most hedgers watch the puts gain in value, but then rather than selling them or hedging them or cashing out in some way, they just hold on to them and eventually those options expire worthless. So while they did provide some sort of mental cushion on the price losses in the cash market, if you never actually realize that profit, there's a good chance that your hedge really did nothing but cost you money. Because if you pay, let's just hypothetically say you pay $1,000 for a put option to protect 5,000 bushels of corn under a certain price. If that $1,000 investment increases to $3,000, but by the time expiration comes around, it's worthless, your hedge didn't do you any good. All it did was cost you $1,000. It might have made you feel a little better in the meantime, but it didn't actually benefit you. So it's really, really critical that if you are going to buy puts for insurance, you have to be willing to take a profit on those or at least put on some sort of hedge, whether it's selling puts or doing something to protect your profits when they do occur. Because the reality is most options expire worthless. So I've just spent 5 slides telling you why buying puts are not the best way to hedge and why they're expensive and they rarely pay off. But ironically, in the summer of 2018, which is what we're experiencing now, long put options would have paid off huge. Not many saw this kind of a move coming. Again, we pointed out this trend line in the last slide. Most traders would have expected this trend line to hold, and fundamentally it probably should have, but politics got in the way and we broke support and the market really never looked back. So in this particular case, it's rare, but in this particular case, that long put option hedge would have paid out beautifully. Let's say that a trader bought a November 1040 put, this is soybeans, near 55 cents. At the time, the market was trading at 10.60. So under normal circumstances, beans would have had to have fallen 70 cents for that to break even at expiration. So for your insurance that you paid 55 cents for, which is $2,750, just for you to break even, for you to get your money back, soybeans would have had to have dropped 70 cents. And honestly, that probably wasn't super likely. That would have been below the trend line support. But in this particular year, it did happen. So this insurance policy would have eventually turned a profit of $5,000. So somebody that spent $2,750 to hedge 5,000 bushels of beans would have been nicely rewarded. It doesn't normally work out that well, but this time it did. And when I just want to make sure you believe me when I tell you options generally erode in value. They generally don't turn profits like we just saw in that last slide, but sometimes they do. Had we not seen a political interference, this option probably would have topped out around 55 cents, which is where the trader bought it, and it probably would have just dwindled slowly. Obviously, that didn't happen. You'll notice that that particular option, you can trade, by the way, you can map or chart options just like you can futures. They have trend lines and all sorts of stuff. So you can always see what the pattern is on an option price. You'll notice, just like the futures trade in a range, options do too. And you'll notice one thing, the value is always declining until we get here, of course. But generally speaking, that's how options behave. They slowly erode in value. They'll spike up and down here and there, but in the long run, they're generally eroding in value. So if you're going to consistently buy put options, you should know this in advance. Okay, so let's talk about something a little different. We've talked about short futures hedges and long put hedges, which are simple hedges that most brokers will tell you about, most brokers will put you into if you're working with a broker. We like to look at things a little bit different. We like the idea of converting simple hedges and standard hedges into something a little more creative, and we think that it does increase the benefits. So again, this is more along the lines of thinking of partial hedges. You don't want to completely give up your upside potential, but you still want to make sure there's some sort of price floor underneath the market just in case something wild happens like we've been seeing in the last couple of months. We did kind of brush upon this a little earlier, but I want to show you a more detailed. If you do put on a futures hedge, first of all, I do believe you should do a partial hedge unless we're extremely high prices. But each and every time the market sells off sharply and you have a futures hedge on, you really should consider selling puts beneath the market. It's an income strategy, and it's an alternative to just simply taking a profit on your hedge and accepting unlimited downside risk. So it mitigates your hedge account profit and loss volatility. So in other words, a lot of times when farmers open hedge accounts, they get frustrated because they start with X number of dollars, and if the hedge works out, their futures account does very well, but they're losing in the cash market, so it's not that exciting. But if the grain market goes up, they're making money in their cash account, which is exciting, but not nearly as exciting as it is painful watching your futures account lose money, and it gets frustrating. So the idea of partial hedges and selling options against your hedges and that sort of thing is intended to reduce the volatility in your hedging account. And so one thing to know about options is they tend to be very expensive at the worst times. So when markets are oversold and they're due for a bit of a price reversal, that's when the put options are usually the most expensive. And when options are overbought, meaning they're reaching some sort of a peak, that's usually when the call options are more expensive. So this is kind of an oversimplification, but just understanding that can take things a long way for you. So we're going to look at the exact same soybean chart, and we're going to point out again, now obviously this is hindsight. We're saying, of course, we should have sold our futures hedge at the very high, but I'm just trying to get the point across. If you sell a hedge, don't just sit on it and wait for 4 months and see, just see what happens. Be proactive. Try to turn that into income. You'll notice at any time if the trader sold a futures contract on a big spike up, he would have been able to take some sort of profit on that hedge out of the market. Wouldn't have been perfect. And I'm not saying it's ever going to be perfect because we don't know what's going to happen tomorrow, but anytime you sell an overbought market and buy an oversold market, you're probably going to be better off. But in this situation, I wouldn't necessarily say sell it when it's high and buy it when it's low. Instead, when it gets down here, sell a put against it. Sell a put down here at a price that we haven't seen in a long time. Before this low, we hadn't seen that price for, I want to say a year and a half, 2 years, but I don't have a long-term chart in front of me. So if you're selling a put with a strike price down here, you're bringing in income to help pay for any type of transaction cost or loss in the cash market or anything that you've got going on, and you'd be consistently able to pull money out of the market while hedging your crop risk. Here would have been obviously not ideal. If we would have sold a put here, our futures would have continued to benefit, but the short put would have basically capped out any potential down here. So we wouldn't have been able to benefit from any of this. But again, this is a rare move. It doesn't happen often. And if we were executing the strategy as it would normally work out, we probably would have made a little money on these hedges. Now remember, hedging is a lot easier than speculating, because in speculating you don't have anything offsetting your risk. So it's a lot easier to be a little more bold when you're hedging than when you're speculating. It's a different ballgame. So earlier we talked about the idea of selling call options against their cash market holdings. So for example, if a farmer is long 20,000 bushels in the cash market, meaning he's planted his corn, he thinks he's going to get 20,000 bushels come October, November, whenever it is, he could sell 4 call options out of the money that expire in 6 months for roughly, we'll just say 18 cents hypothetically. So this creates an additional $3,400 in income, and that $3,400 in income basically gives him an 18-cent cushion in the cash market. So if corn is lower by 18 cents, it really doesn't matter. He offsets that price risk with the call options that he collected. If corn continues to go higher, he's not really giving anything up. He still gets to keep the 18 cents or the $3,400. The opportunity cost is if corn goes more than 30 cents higher, we were selling options that were 30 cents out of the money, then he's giving up any profit potential above that. And on most years, that's probably pretty attractive. Here's a chart of what something like that might look like. In this particular case, we might have been, the market's overbought here, somewhere in this ballpark. Corn's around, we'll just say 415. So somebody might have looked to sell the 440 calls for 18 cents. That means the cash market gains have room to run all the way up to 440. At 440, it runs out. If corn goes to 450, 460, 470, the trader doesn't benefit. But all the way up to 440 plus, actually I take that back, plus 18 cents. So we'll just call it 458. All the way up to 458, the trader is doing just fine. Above 458, he's giving up any profit potential on the upside, but I think we can all agree that's a pretty fair bet. And on most years, that'd work out pretty well. In this particular year, we saw such a huge down move in corn that 18 cents really didn't matter. In fact, it was inconsequential. So you can see how selling calls alone with no other strategy can be great at times, but if the bottom falls out, the money that you collect isn't going to do what you need it to do to truly hedge your price risk, because you still have open-ended price risk down below. And we're going to show you how to combat that in just a minute. So now we're going to talk about, is it possible to purchase free insurance? And believe it or not, the answer to that is yes, you can. When I say free, I'm talking about cash, out-of-pocket expense. There are opportunity costs, and we'll talk about those, but you can establish free insurance. So in my opinion, this is the best way to go about hedging, whether it's meats, grains, your stock portfolio, whatever it is. I think this is the best way to do it. This particular strategy is known as a risk reversal, and it's the idea of buying put options equivalent to the amount of exposure wishing to be hedged, then selling the same number of call options to pay for those puts. So again, it's free. If you're selling a call option and you're using that money to pay for the puts, you have free insurance. The only opportunity cost is you forfeit any gains above the strike price of the short calls. So in other words, you're mitigating your downside risk. In fact, you're actually eliminating your downside risk at a certain point in exchange for eliminating your profit potential on the upside. So again, I say the word free because I'm talking about cash, money, but there is opportunity cost. We already talked about that. You're capping your profit potential on the upside. But there's also a margin cost. Futures brokers are going to require a margin to cover the risk of being short a naked call. So even though you know you have corn to the ground and you're making money in your cash corn, the futures broker does not care about that. All he cares about is how much money you have in your futures account and what the current margin requirement is. And keep in mind, I want to point out before we go any further, not all brokers are going to allow you to sell naked options in your brokerage account. So before you try to do a strategy like this, make sure your broker allows it and make sure they're reasonable in regards to their rules on how they treat it. Just to give you an idea of what we're talking about here, the margin can be depending on how aggressive your hedge is. So for example, when I say aggressive, I mean selling option closer to the money and buying a put option closer to the money. If you have a conservative or a moderate hedge, you're going to be selling a call that's further out of the money and then buying a put that's distant from the market. So it's not as easy as saying the margin is going to be X number of dollars and it's a flat rate. It's not like that. Each trade and how it's structured and the expiration month are going to play a factor in that. But it could be anywhere from $500 to $1,000 to hedge 5,000 bushels. So if you're expecting 40,000 bushels, you could probably be looking at an account of 10 to 15,000. Honestly, I'd probably recommend you put a little more. But in theory, a $10,000 to $15,000 account, you could execute a free hedge. And we're going to look at an example in a few slides, but I just want to make sure that even though we're talking about hedging, not speculating, timing is everything. If you have good timing, the result is going to be better insurance. You're going to have a higher cap on your profit potential, meaning you can make more money if the market goes up. You're going to have a higher level in which your downside protection kicks in. So your put option will have a higher strike price. The hedge will benefit you more. And you're less likely to incur margin issues in your futures account. Remember, if you put on a hedge like this, if you sell a call and buy a put, and the price of corn or soybeans or whatever it is goes higher, the margin to hold that trade is also going to increase as the futures price gets close to your short call option. So it's possible, even though you're making money in the cash market, it's possible that you would have to actually get a margin call and have to send more money. So keep that in mind as well. But as long as you pay attention to timing, hopefully that won't happen. You always need to hedge when you can, not when you need to. You do not want to wait until the house is on fire to buy insurance. Okay, so this is how a free insurance or a risk reversal might look. So we're going to use the same corn example we just looked at. So let's say corn's trading roughly around 415, somewhere in this ballpark, and we want to make sure that first of all, we want to give corn a little bit of room to move on the upside, but we also want to ensure that we're protected if corn collapses. So one thing we could do is we could establish free insurance by selling a 440 call and collecting 18 cents. And oops, there's a typo in this slide. This should be a $4 put. So we would be selling the 440 call and then buying a $4 put for 18 cents. The cost is free. We're selling 18 cents and we're buying 18 cents. So there is no cost other than commission and some margin. And again, the margin would be $500 to $1,000, and commission is depending on what you've arranged with your broker. It's probably going to be pretty minimal. So I mean, we're talking less than 50 bucks total, maybe even a lot less than that. Anyway, so you get the idea. There's really hardly any money being exchanged here. The result is you're getting insurance under $4. So anytime, well, I shouldn't say anytime, but if corn is below $4 at any time before expiration of that option, you're going to be making something on the trade. In this particular case, the farmer would be making roughly 40 cents on his hedge. So he made 40 cents on a hedge that he paid nothing for. The downside of this would be there would be no benefit if corn continued to rally. That farmer would be giving up anything above 440. So you can see this type of a strategy makes sense on an upswing because it's easy to see corn came from 370 up to 420. So we're already talking 50 cents of price movement here in the last, I mean, it did take a while to do it. But even if we look at from here, from 390 to 420, 425, we're talking 30, 35 cent move. So when corn has a big move already, the chances are it's probably not going to continue to move a whole lot higher, although sometimes it can, and that again brings up the discussion of partial hedges, not full hedges. So if you're hedging 30,000 bushels, you may only want to put this type of an insurance on half of it, maybe 20,000. If it gets up here, you might want to do another 10,000 and so on and so forth. So it does not have to be all or nothing, but this is a great way to get free insurance, and you can't beat free. So we've mentioned this over and over and over, but I want to make sure everybody remembers timing is everything. Warren Buffett said it best, be fearful when others are greedy and greedy when others are fearful. You don't want to put on your hedges on a downswing. You want to do it on an upswing. I also mentioned this, but I want to reiterate it. I like to use RSI. You might use Williams %R or slow stochastics. Honestly, it doesn't really matter. Each indicator is pretty similar in overbought and oversold. Some of them are quicker, some of them are slower. I like a slower indicator because you're going to have less noise. So I prefer the RSI, but you can play around with it and figure out what you're most comfortable with. But the odds are, if you are establishing your hedges on overbought market, the odds are the market's probably going to trade counter trend, even if it's just temporary, or or at least pause or digest. And that's really all it needs for some of these option strategies to pay off. This is a wheat chart, so we're switching to a slightly different commodity here. And wheat is quite a bit more erratic than corn, but maybe not quite as erratic as soybeans. So if you're looking for something in the middle as a speculator, this might be something for you. As a farmer, obviously, you don't have a choice as to which market you're hedging or not hedging. I mean, you make that decision in the spring, and you have to stick with it. But you'll notice that wheat does have massive price swings followed by fizzles, and this happens a lot in wheat. I will never forget 2007 when wheat went to 13 bucks. So there are times where something like this, it looks like it should be done, and it'll probably reverse just like it did, that it just simply doesn't, and it just keeps going. But shoot, that was 11 years ago. We're still talking about it, but it still was 11 years ago. So those types of things don't happen very often, even though that's what we tend to remember. You can imagine how much better of a hedger or a hedge you would have if you were savvy enough to do it on the highs as opposed to on the lows. It's a lot easier said than done, obviously. It's easy to pull up a chart and say, well, you should have, could have, would have done this there. But the reality is we're humans, so we want to do the exact opposite. We want to hedge when things look bad and take off our hedges when things look good. But we really have to train our minds to think in the opposite manner, because that's really not how it works most of the time. Another thing to keep in mind is seasonals. When you're hedging, not only do you want to look at overbought and oversold markets, but you want to look at the seasonal patterns. For example, this is corn, and soybeans follow a pretty similar pattern. Wheat's a little different. It's on a different harvest cycle, but honestly, it somewhat follows corn and soybeans despite that harvest cycle. But we know that corn and soybeans tend to bottom in October. Sometimes it's a little early, sometimes it's a little late, but that's generally what happens. And then they spend the rest of the year moving higher until we get into early summer, late summer, and they tend to sell off from there. So some of you that may or may not be following some of our newsletters or on a trial, or our clients of ours, you might be wondering why we have bullish positions on in soybeans and soybean meal, despite the seasonal pattern that obviously suggests the grains go lower during this time of the year. And the reality is seasonals aren't perfect. Sometimes they come early, and so we're hoping that that big tariff sell-off, tariff tantrum sell-off, whatever you want to call it, was simply bringing the seasonals forward. And so we're hoping for some stability going forward, but only time will tell. The reality is, though, you really want to make sure you're timing your hedges based on seasonal patterns. Again, you don't want to be hedging in October. If you're in October and you haven't hedged yet, you've missed your shot. Just wait until the next spring or maybe even summer to start hedging again. Okay, so I know that I speak to farmers and ranchers all the time, and what confuses them, they know about going to an insurance company and purchasing different types of insurance and priced insurance and that sort of thing, but they don't know about how to open a commodity account. It's actually a very simple process. Nowadays, it's all electronic. It's electronic. I'm sorry, the application's electronic, so you just click on the link, you fill out your information, and we can usually get people up and running in a day or two. So if you are interested in doing some hedging and you're interested in filling out an application, email us. It's a very painless process. The trick is you do not want to unnecessarily trigger Chicago Mercantile Exchange pro fees. For those of you that do not know about the pro fees, the CME has decided there's two categories of traders. There's professionals and non-professionals. If you fall into the non-professional rank, the fees for accessing live market data is only $3 a month. But if you are a pro, if they determine you to be a pro, they jump up to over $400 a month. And that's not an error, from $3 a month to $400 a month. So you want to be careful on how you open the account, and I can help you with that. Basically, if your farm corporate entity partnership is owned by anybody other than you and a spouse, you want to probably do your hedging in an individual account and let the accountants deal with it on the other end. Otherwise, you're going to be paying a lot of money unnecessarily, so there's that. Anyway, we would be happy to answer any questions that you have and help you out. You can email us at info@decarlitrading.com. Another thing to keep in mind is most people that are looking to hedge their price risk want to open a hedge account, and that sounds absolutely rational, right? It sounds reasonable. If you're hedging your corn or your soybeans or your meats, whatever it is, it sounds like you should open a hedge account, but believe it or not, it's probably not worth the effort. You're probably going to be better off opening a speculative account, and here's why. If you open a hedge account, it opens all kinds of responsibilities and compliance issues, not necessarily compliance, but you may be asked to confirm that you own the particular item that you're hedging. Your account is probably going to be set to trade only in that particular commodity. So if you're a soybean farmer and you want to hedge soybeans, your broker might actually only allow you to buy or sell futures contracts or maybe buy puts. They may not allow you to even do some of the strategies that we talked about today. The only benefit of trading in a hedge account versus a speculative account is a margin break, and the margin break is not that significant. It is a few percentage points. So for most clients, I recommend just opening a speculative account and we'll do some hedging in it. It's no big deal. Regulators tend to refer to the risk reversals and things like that as speculations, even though they really are hedges, but it's just a different way of looking at things. So in my opinion, open a speculative account. It simplifies everything, and the hedge account's probably not worth the extra couple percentage points in margin. So if you're unfamiliar with how the commodity business works, you can, nowadays most people trade online. So you would have access to a trading platform, a mobile device, so you could download an app on your mobile phone and view your hedges from there. You could actually even establish positions if you wanted to. We also offer 24-hour trade desk and full-service brokerage for those that aren't interested in placing their own trades or just need some hand-holding. So a lot of farmers that I speak to, they're not necessarily comfortable with technology, and they have so many things going on during the day that they just simply don't have time to learn something new, and they don't have time to follow the markets or learn the different strategies or that sort of thing, and they need a little help. And so that's why I'm including some of these slides, is to make sure that anybody that is interested in doing some hedging knows what we offer and what we can do for them. We offer everything from full service to self-directed online. We can help you establish your strategies based on your risk tolerances, what exactly you're hedging, how aggressive you want to get with your hedging, that sort of thing. I can't emphasize this enough. I am absolutely a biased opinion on this subject, but I really, really, really want to make sure everyone understands that if you are looking to hedge your price risk, Don't try to save pennies by going to the cheapest brokerage, because a lot of times those brokerages that are offering super discount commissions, they are cutting corners. They're either charging higher margins, they may not have an experienced staff that can help you. They may be restricting your market access. They might not allow you to sell options. They might not allow you to trade certain markets or during certain market times of the day. And the commodity markets are almost 24 hours. The grains aren't quite 24 hours, but they trade a night session and a day session. You want to make sure you have access to all of the market hours, and not all brokers offer that, so be really careful. So in conclusion, hedging price risk is just as important as any other type of risk management, such as crop insurance. If you're not implementing a hedging strategy, you're basically speculating in the cash market. So you don't want to be a speculator. You want to be a hedger slash a business person. In business, you want to know what your bottom line is, and the only way to know that in advance is to hedge your price risk. Hedging in the futures and options markets does not have to be an all or nothing venture. You can do it in increments, and we can help you do that. So it pays to get creative with hedges. Your hedges don't have to be simple long puts or short futures. You can do a little bit of both. And in fact, as we mentioned, we can establish free hedges, which are awesome. The only downside is, again, you're giving up upside profit potential. So if corn goes to $8 or $9, it's going to be a really sad year for you. But probably 15 out of 16 years, you'd be really happy you put on a strategy like that. Because again, those big, giant, explosive moves are pretty rare. So I want to thank everyone for coming out. I know this is a little different than what we normally do, but we wanted to make sure. We get a lot of farmers and ranchers calling us and asking for help, and so we want to make sure we had a resource for them, and here it is. And if you're looking for some more information, not necessarily on hedging, but on commodities in general or speculating, our two books hopefully are great resources for you. And if you have any questions, or if there's anything that we can do for you, please give me a call or send me an email. I'd love to hear from you. Thank you for coming out.